Has your company promised some shares to its directors for their work or service? Or did you offer some cash bonus where amount depends on the movement of your own share price? Then you're welcome to watch this summary of IFRS 2 share-based payment that exactly specifies the rules for similar transactions. I am Sylvia of cpdbox.com, the website with loads of articles, videos, lectures, discussions, and other materials for accountants. So if you need to learn some accounting concept, pass your exam, get answers to some of your questions, you're very welcome to check out cpdbox.com. So IFRS 2 has been issued in 2004 with later amendments. The objective of IFRS 2 is to specify the financial reporting by an entity when it undertakes a share-based payment transaction. So the entity shall reflect the effect of these transactions in its profit or loss or statement of financial position. So what is a share-based payment transaction? It is a transaction in which the entity receives goods or services from the supplier of those goods or services, including an employee, in a share-based payment arrangement, and we'll define it in a minute. So if this is the case, then the entity must apply IFRS 2 for reporting this share-based arrangement. Share-based payment transaction is also a transaction involving more members of the same group. So let's say that your entity, a parent, incurs an obligation to settle the transaction with a supplier in a share-based payment arrangement when not a parent, but a subsidiary or other group member receives those goods or services. So here another group company receives the goods or services, but if the liability to pay for them by share-based arrangement is transferred to an entity, then IFRS 2 applies to the entity that needs to pay. Let's sum this up and see what share-based arrangement is. It is an agreement between the entity and another party, supplier or anyone else, that entitles the other party to receive either cash or other assets for the amounts that are based on the price or value of entity's equity instruments. So in this case, supplier gets paid for its goods or services by cash, but the amount of cash is determined with reference to entity's equity instruments price. These transactions are called cash settled. The other party or the supplier can also be paid by equity instruments of the entity, including shares or share options. This is a very common way to remunerate some employees of big companies. They receive share options in return for their work for the company. And these transactions are called equity settled. And it's very important to determine whether we're dealing with cash settled or equity settled transaction because the accounting treatment depends on that. There could be also some vesting conditions, and these are some service or performance conditions that the other party must fulfill before being entitled to share-based payment. For example, directors might be entitled to receive the shares of the company after 5 years of their service, and these 5 years are a vesting condition. Now let's take a look at how we shall recognize the share-based payment transactions. The first question is when to recognize share-based payment transaction. An entity shall recognize goods received when they are delivered or obtained by the entity, or if it relates to services, then the recognition occurs as the services are provided. Another question is how to recognize a transaction. That depends on the type. If the transaction is cash settled or an entity pays in cash based on the price or value of its equity instruments, then it's necessary to recognize the services or goods received. So we need to debit either assets, inventories, or expenses, and corresponding credit is recognized as a liability. If the transaction is equity settled, then debit entry is the same and the corresponding credit is recognized as an equity. So these are the basic recognition criteria, and let's break them down more specifically in line with various types of transactions. Let's take a look at equity settled share-based payment transactions first. In these transactions, an entity acquires certain goods or services from the supplier, including employees, and pays for these services with some own equity instruments such as shares or share options or anything similar. How shall we measure such a transaction? The basic rule is to measure the amount of goods or services received and corresponding share-based payment at fair value of goods or services received at the receipt date. This approach is very common when an entity acquires certain goods or services from the third parties, where it's possible to determine the fair value of these goods or services. But entities very often provide share-based payments as a part of some remuneration package to their employees. And in this case, it's very difficult, if not impossible, to determine the fair value of services received from employees. And therefore, IFRS 2 requires using the fair value of equity instruments granted instead. So instead of determining the fair value of employee service, an entity should estimate the fair value of its own equity instruments granted, and IFRS provides the whole guidance on how to do this. And basically, this fair value is estimated at the grant date, not at the receipt date, as these remunerations are usually provided in exchange for the employee's service over some period. There's one more thing to bear in mind: vesting conditions, or whether share-based payment is vested or not. So if these benefits are not vested, it means they are granted immediately, and the counterparty is not required to complete some specified period before becoming entitled to those equity instruments. And in this case, IFRS 2 sees this remuneration as in return for past service, and therefore an entity shall recognize the services received in full at the grant date with the corresponding increase in equity. But if these benefits are vested, the situation is different. In such a case, a counterparty is required to complete a specified period of service. For example, employee gets 100 shares of his employer after 3 years of service. IFRS 2 regards these shares to be provided for the future service over the vesting period, and therefore these services are recognized over the vesting period with the corresponding increase in equity. So vesting conditions are not reflected in the fair value of one share granted. Instead, they are reflected in a number of shares that an entity needs to recognize each year over a vesting period. Let me also add that IFRS 2 prohibits subsequent adjustments to total equity after vesting date, but it permits transfers within individual equity components. So if, for example, some share options are not exercised, an entity does not reverse share option rights, but adjusts this situation as a transfer within equity. Let's take a look at cash-settled share-based payment transactions. In these transactions, an entity acquires certain goods or services from the supplier, including employees, and pays for these services with cash or other assets in the amount determined by the reference to own equity instruments, for example, share appreciation rights. Here, employee gets payment based on the entity's share price increase, or rights to mandatorily redeemable shares are another example of that. As these transactions are typical and common in remuneration of employees, let's focus on measurement of share appreciation rights. This is a cash-settled transaction. The credit side of the entry goes to liabilities, not equity, but we have mentioned that already. This liability shall be measured at its fair value on initial recognition, and the fair value of liabilities from share appreciation rights shall be determined by the application of option pricing model taking into account the specific conditions. The liability shall be remeasured at each reporting date until settled. So this is a bit different from equity settled share-based payment transactions. Of course, share appreciation rights can be both vested and non-vested, and here the rules are similar to equity-settled share-based payment transactions. So if they are not vested or employees are entitled to them without further conditions, then an entity shall recognize them fully. And if these payments are vested and certain conditions or further period of service is required before entitlement, then they shall be recognized over the period of vesting. The standard IFRS 2 deals also with other issues related to share-based payments, such as modifications, cancellation, and settlement. And IFRS 2 also requires certain disclosures and provides the guidance on measurement of share-based payment transactions. So this was a very short summary of IFRS 2. I appreciate you watching the video and I trust you learned a lot. And if you need to learn more, get your CPDs and answers to your questions. feel free to visit cpdbox.com, sign up for my free newsletter, and please share this video with your friends if you think it might be useful for them. Bye!